Matthew, it's good to have you. Let's cut right to it. Well, I guess before I ask you specifics, what's your base case for what happens with the economy right now?
Well, I would just preface my comments by saying the crystal ball is cloudy at best. I think it's very difficult to call the economy, and I think we just have to remember back to the time of COVID how few economic forecasters predicted that. But I think it's fair to say that quite a deceleration is baked into the cards. If we look at some of the leading indicators, credit spreads, market breadth, the forward yield curve, for example, or the ISM New Orders Index, let alone some of the inventory data that we're seeing out of the big retailers and the fiscal contraction that we've got, it seems that we're set for quite a meaningful deceleration in economic growth in the U.S., and we're seeing those trends elsewhere around the world, in China, Europe, and the like.
So you acknowledge it's going to be tough sledding. Against that backdrop, give me the 5 stocks. I'm sure there are more than that, but at least 5 that you think our audience could bank on right now.
Look, I think it's the time for realism. Last year, we probably saw the lowest cost of capital in a generation, and markets cleared at levels that they probably couldn't sustain. So I think this correction's been healthy. And our response to this kind of environment is to think like business owners. We're not trying to predict where the market bottom's going to be. So we're trying to put together a thoughtful barbell of businesses that offer basic essentials in different industry groups. And so you might have defensive cash flow generative businesses like Comcast, for your Wi-Fi, or a corporate staple like Oracle in relational databases. These are cash flow machines with mid-single digit free cash flow yields and mid-single digit growth. In the consumer space, some of the names in Europe are quite attractive. We see names like Danone with close to a 6% free cash flow yield. In some basic products like infant nutrition and bottled water and dairy yogurt. And so these kinds of businesses, I think, can form the basis of a barbelled approach to investment allocation, where you're not trying to pick the bottom of the market, because it could be a lot lower if we get a recession or if we get a monetary crisis, but where you're trying to position yourself as a business owner for the next decade where the arithmetic makes sense.
Peter Bookvar yesterday also mentioned that he thinks European stocks have, in some cases, more attractive valuations here for investors who are sort of picking through the rubble. But I've also heard that Europe's recession could be deeper and worse than what we're facing because of their exposures to Russia and energy and some other issues.
So Europe does face the problem of higher natural gas prices, whereas the U.S. is more integrated in terms of its energy production, and so it's somewhat shielded from that. But let's not lose sight of the fact that the United States economy was the beneficiary of much more stimulus, greater money supply growth, lower real interest rates, greater fiscal deficits. All of that is unwinding. We've had a fundamental regime shift here where money supply could contract, where it's not just interest rates that are going up, but we're seeing a very substantial fiscal contraction. And so the U.S. benefited from very easy policy conditions that are now normalizing. And so things could get equally challenging in the United States.
So even on the stock picking front, I'm sorry, no, I take your point. So Oracle's one of your stocks that you like. How do you respond, for instance, to Cisco's decline last night? I mean, does that tell us that even relatively staid parts of this, the economy can be vulnerable to the period that we're going through? Or does it highlight to you the difference in picking the right stocks? Maybe you would take an Oracle over a Cisco, for example.
Look, I think if we end up in recessionary territory, I think most businesses are going to suffer in one form or another. And we've seen that even across the retail complex, where the sort of staples retailers are doing pretty poorly, as well as some of the discretionary retailers. And so I think it's impossible to totally escape a tide going out. But what I will say in the case of Oracle is that the majority of their operating profits come from recurring maintenance fees on the databases and the enterprise application software that they've installed. And so that's a more stable cash flow stream than having to sell new products to customers.
And I should mention a couple of other names among your top holdings: Meta or Facebook, C.H. Robinson, Philip Morris, Anthem. So a diversified basket there. Matthew, thanks for I would say sort of talking us off the ledge or talking us through it for your ideas in a very difficult environment. Thanks for joining us today.
Thanks, Kelly. And it's comforting to see folks like Warren Buffett committing some capital here, but I think that they're not committing their last dollar. They're prudently doing it in a measured way.
All right. Well said. Matthew McLennan of First Eagle joining me today.
Shepard Smith here. Thanks for watching CNBC on YouTube.